Good afternoon and welcome to the Inspired PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Mark Dickinson, CEO. Good afternoon to you, sir.
Good afternoon, everybody, and welcome to the FY24 interim results for Inspired PLC. Presenting for you today, myself, Mark Dickinson, Chief Executive, David Cockshott, Chief Commercial Officer, and Paul Connor, Chief Financial Officer. I guess as a start, let's focus on reminding ourselves what the business does. The group is a B2B business delivering solutions to support businesses on their journey to net zero. We do this by helping those companies manage the 4 C's of cost, consumption, carbon, and compliance. We're organised into 4 divisions. The first, software services, owns and develops our proprietary software that underpins our technology-enabled assurance and ESG services. This proprietary software platform is now increasingly recognised as a leading platform in the marketplace, with more than 60 market participants utilising it. Our assurance services division helps businesses manage their energy costs and defend against energy crisis and volatility in utilities. Our ESG services division helps clients manage and solve the complexity in relation to making ESG disclosures and developing ESG strategies. Our optimization services division then takes those strategies and actually helps clients implement them, delivering the commitments they have made to net zero over time. During the half, we've had a fantastic performance in relation to new business developments, picking some fantastic brand names and adding them to the client base. For these clients, the majority have joined the group for assurance and ESG services. And as we help them manage their energy costs and make their ESG disclosures and develop their ESG strategies, we are then well placed to help them actually deliver and implement the commitments they have made to deliver net zero. And as we do so, increase the client lifetime value of those customers to the organisation. We benefit from 3 key market drivers. The first is the higher energy prices and the fact that businesses do not want to end up in the same situation as they were during the energy crisis of 2022. For most businesses, utility costs are their largest indirect spend, and any variation in those costs typically flows straight to bottom line. Ultimately, this can cause EBITDA shocks for those organisations. We help businesses manage and control that risk and create a defence against future energy crises. The second driver is increased ESG disclosure requirements. Whether that increase in disclosure requirements is coming from a business's customers, from their investors, or their need to meet regulatory compliance obligations, we stand shoulder to shoulder with those businesses, solving the complexity of those disclosures, processing the vast amount of unstructured data that's required to make them, and ultimately helping them determine the ESG strategies that are appropriate for their organisation. The third market driver is the current drive for businesses to actually meet their ESG commitments. So now many businesses have made commitments, they've published them, be them science-based targets or roadmaps to net zero. And the time has now arrived when those businesses have to start to make good and deliver those commitments. Our business is uniquely placed as a one-stop shop to help those organisations not only process all of the data to manage their energy costs and develop their ESG strategies and disclosures, but to also actually implement those solutions that effectively remove the excess carbon emissions or wasted energy consumption from their portfolios. Our operating model is one of land and expand. Clients join our company through either the Assurance Services Division or the ESG Services Division. Once they've joined us, we take them on a journey controlling the risk of energy and utility prices and delivering ESG disclosures. And as we do that, we develop a wide range of contacts across their organizations, often culminating in C-suite. Because we process large amounts of data in relation to their sustainability equation, we are well placed then to sit in the room and help those organizations identify and implement the correct products or correct solutions at the correct time for their organizations. Ultimately then, our optimization services division helps the client implement those solutions, reducing those units of carbon emissions, reducing that wasted energy consumption, and helping those organizations not just talk about delivering their commitments to net zero, but actually delivering them on a real-time basis. With respect to financial performance, we've been really pleased with the increase in gross profit between periods of 10%. Of that increase, all divisions contributed to gross profit increase, but the primary driver was increases in our optimization services division. Of that increase, 4% flowed through to an increase in adjusted EBITDA, albeit adjusted PBT decreased based on increased financing and interest costs. A particularly pleasing element of the half was the increase in cash generated from operations, increasing up to over £9 million. And ultimately, with 2005 seeing the group having no more contingent consideration to pay and the cash from operations flowing down to deleveraging the company and pursuing organic growth opportunities, we are well placed to create an environment where more of the growth in EBITDA flows to growth in PBT in the future. As we mentioned, our strategy is one of land and expand. Effectively, we onboard clients into the ESG and assurance divisions where we help them solve the complexity of making disclosures, process all of their unstructured data, and start on that journey to deliver on their net zero commitments. We focus on cross-selling ESG services to assurance customers and then optimization services to both assurance and ESG customers. We've been really pleased with the performance of new business development during the period, and really enjoying seeing stability and consistency that's come into our cross-sell engine, as you can see between half 2 23 and half 1 24, noting that there's always the opportunity to overperform as we did in H1 23 due to compliance drivers such as the Energy Savings Opportunity Scheme that was particularly important during that period. So in terms of the group, I guess the key thing is half-year performance in line with management expectations, with particularly pleasing developments in relation to the performance of new business generation. I'm now going to ask Paul and Dave to walk us through the individual performance of each division.
Thanks, Mark. Okay, starting with the assurance division, just a reminder what we do here. This is the division that helps customers to buy their energy at the right price, at the right time, in the right way. And then when they've done that, it helps them account for that energy, understanding their estate, understanding their data, and where and how their energy is used. It's our main acquisition channel, and we've got very high retention rates in the area, over 90%. Great forward visibility of revenue and long-term contracts, as you can see there from the quote from Iceland about their recent long-term renewal for our assurance services. Margins, pleased to say, as expected, are stabilising at the 40+% level, and we are the undisputed market leader in this particular space. Our focus as a division is on delivering that first-class service, making sure there's absolutely no reason why we don't create a fertile ground for that expansion mode of being able to sell in the other services that the group offers.
Thank you, Dave. So from a financial perspective, in the period, the division performed in line with expectation. So revenue growth of 3%. As Dave said, margin stabilised to the full year 41% we saw in FY23. Following that period in which this division reacted to the customer need during the energy crisis, when we invested further costs in ensuring that we maintained what we believe to be a market-leading service. Without delivering that service, ultimately we're not unable to enable and facilitate the cross-sell opportunity which we believe will drive the growth opportunity which exists for our optimization services and ESG services in this market.
Moving on to our ESG division, since our organic entry in 2020, we've demonstrated that this absolutely is no fad. It is here to stay. It is revenue and investment critical. If a B2B business doesn't have a credible net zero strategy, then customers and investment will be going elsewhere. It's a complex area. It's constantly evolving. CSRD and TNFD, new legislations that create that need and the tailwind behind us for developing those products for our clients. We take a very different approach to this area. It is data-led. It's reporting framework agnostic. Whichever way the customer wants to report it, that is a way in which we can help them structure it to be able to comply with their requirements. That resonates with customers, both new as we win new business, as you can see there, but also that cross-sell into our existing base where they too are appreciating the new services we can deliver, helping to deliver that 17% growth in revenue. It's a natural route and a natural extension for our optimization business, creating that nice flow of business between the divisions.
As Dave said, 17% revenue growth for this division, period on period, half on half. Pleasingly there, you'll see a compound annual growth rate of in excess of 90% since that organic entry into this area in 2021. As we saw at the full year 23, now contributing materially to group EBITDA in this period, and as I say, for the full year 2023, still very much in its growth phase. So after our initial investment on entry into the space, now contributing profit, margins wise, we believe this to be a business model which is comparable to the assurance business, both in terms of contractual visibility in your revenue line, but also margins. So we believe this to be a 40% EBITDA margin business at maturity. But clearly, the division is still very much in a growth phase, and we're right sizing our investment cost in maximising the top line growth opportunity that presents itself.
Moving on to the growth engine, the optimization services division. This is the area that focuses on actually removing carbon emissions, cutting costs, eliminating wasted energy, and of course, wasted water, that forgotten utility. It's the cross-sell goal for Inspired. We work with many household names that you can see on the chart there. We have a great pipeline of opportunities for these services, driving and helping customers to decide where to spend that next pound of capital to be able to remove that marginal wasted unit of energy and that marginal carbon emission. The focus is now on bringing together the Ignite and Inspired teams to build a broader platform and capitalise on those resources to be able to diversify and deliver through more of our customer base.
Thanks, Dave. So a 21% increase in gross profit in the optimization service division, noting we focus on gross profit from a financial KPI for optimization. And the reason for that is because of the pass-through impact of the solutions provided to our customers in any period, noting that we end-to-end the solution to the customer, and therefore through our revenue line and also our cost of sale line within this P&L for optimization services, we incur the cost of the equipment and the installation for the fit out. And therefore our focus is very much on gross profit. The costs from an internal perspective in terms of quality assurers, health and safety, data managers, account managers, etc., sit within overheads. And therefore absolute GP growth is our focus. Because of that pass-through element of the revenue and cost of sale, of the equipment and the installation cost, we give a range of outcomes for EBITDA margin in this area. That range is from 20 to 25%. This period so happens to be at the higher end of that range because of the solutions provided in the period. But ultimately, this area is a part of the business which we deem to be the real growth engine of the business as we look forward to 25 and 26. You'll note that as per the previous 2 financial years, we've seen a 40% GP contribution from optimization services in the first half of the year and 60% in the second half of the year. And that's very much driven by the client concentration we have at the higher end of optimization, working around client financial year ends and subsequent CapEx budgets, and allocating those CapEx budgets to deployment of those projects in any financial period.
And finally, onto the software services division, which is the foundation of our delivery for our clients. Here we continue to push the boundaries and develop new modules, making our software solution the de facto solution for within the market. There are many customers and the market just relying on our software solution for their delivery. It's an area with a very high retention rate, over 95%, and excellent margins, over 60%, a clear market leading product.
Consistent revenue growth from our software services division, noting that ultimately our software services division is an enabler and a facilitator for our other 3 divisions. So the P&L for software services represents customers who who license our software, and this is customers we bill directly for use of the software. We've delivered in this period 17% growth, compound annual growth rate 14.5%, high EBITDA margin as a business following a period of investment, very much now positioned to generate operational leverage over the coming periods. But as we say, ultimately a facilitator and an enabler, as well as being a market leader to enable the delivery of the services in our other 3 divisions.
What we thought we'd now do is just bring all of that together into this case study that we've perhaps shown before, but I think it's worthwhile just emphasising this holistic solution. So the example is Nuffield Health and how we've transformed them through their effective energy management. Number of figures there that are quoted. The first one, £250,000 worth of negotiated savings. As we say, the assurance business helps businesses to buy energy in the right way. We can't help what happens within the market, but we can make sure that customers have the right kind of contract and contract structure to be able to help them to buy energy effectively within the market. £250,000 worth of negotiated savings there. We then help them account for that energy correctly. In doing so, the bills that are coming into us, when we validate them, we've identified £1.4 million worth of billing errors that we got corrected before they were paid. You'll notice another figure on there, 217,000 of retrospective. So this is where we've gone back over previous invoices that they've already paid prior to our involvement, and we've identified errors on those invoices totaling £217,000 that we've got returned for them. The 666,000 was actually another saving pre-invoice. So there are certain charges that are reconciled and billed offline. Well, the statement came through to us for their triad charges. We noticed a number of errors on there. So before it even got onto a bill, we were able to reduce that charge by £666,000. There's also water savings and meter operator savings. So a very effective assurance business there, tying all those ends together. We've also then gone on to expand into our ESG services, so we can help them with their CFD reporting, and more importantly, now they have their net zero goals, we're also starting talking to them about how they're actually going to achieve those and actually help them remove those units of carbon through our optimization services as well. So a real example of the end-to-end service offering that we can provide for clients.
Thank you, Dave. So just to put it all together, I guess, from a group financial perspective in the period, in terms of the segmental performance, we provided a similar bridge at the full year position. This is the half year position, just illustrating that diversification of the group from a wholly assurance service provider pre-2021 to a full suite service provider in 2024, with that growth in top line revenue and also EBITDA very much coming through from the optimization services and ESG services divisions. From a cash flow perspective, clearly a key focus of the group. Really pleasing cash conversion metric in the period. So we generated 87% of profits into operating cash. As we know, because of the Q4 weighting, expected Q4 weighting of projects in the second half of the year, we noted in the RNS this morning that we expect that metric to reduce for the 12-month period ending December, as we have the working capital investment in delivering those projects into the period end, and that working capital expected to unwind in the new year. You'll note in terms of cash flows from investing activities, clearly a key part of our cash flow over the last 3 to 4 years has been the payment of contingent consideration. You'll note that we've paid a comparable level in first half of 24 to what we paid in 2023. But you'll note per the trading update on the 16th of August, very much at an inflection point now in terms of contingent consideration liabilities for the group, on the back of entering the deed of termination of the Ignite deed of variation, on payment of the current liability of 2.2 million in the balance sheet at the 31st of June 2024, which will be paid in October this year. The group will no longer have any contingent consideration obligations, acknowledging the performance fee that we've put in place for the Ignite vendors through the restructuring period out to the 31st of May 2025, the volume of which we expect to be circa 2.3 million, which we will pay in the first half of next year. Subsequent to that, as we've stated, the board's objective is very much to move the leverage of the organisation, net debt to EBITDA, to nearer 1 times as soon as feasible, whilst also enabling and facilitating the opportunity to execute on the growth strategy that presents itself, particularly within the optimization services division.
From the half one results, satisfying results in line with management expectations, and ultimately really pleasing performance from a new business development point of view. That's unfortunate timing. I guess kind of ultimately when we start to look at the kind of summary and outlook moving into FY24 and beyond into 25, from an assurance, ESG and software perspective, we continue to perform in line with expectations. We're really pleased with the size and scale of the pipelines that underpin each of the business divisions, and really give us a strong conviction as to the growth opportunities into 2025 and beyond. One of the things we have noticed as we've come into the period is that as we get better at serving clients in relation to optimization projects, delivering those solutions to reduce carbon emissions and energy consumption, we find that actually we're getting access to bigger and bigger projects. And from that perspective, we entered the period with a dependency on 3 significant projects. I'm pleased to say that one of those is now contracted and the other 2 are anticipated in Q4. As we start to work as a management team, we really are focused on making sure we diversify this client concentration risk, which has been accelerated through the integration of the optimization team within Inspired and the Ignite business team. We're currently in the process of transforming that into one operating model, which ultimately provides significant capacity to ensure we can help more customers simultaneously help meet and deliver their net zero commitments that they've made to the marketplace. As part of that process, we were also able to remove the contingent consideration aspects from the business. So from FY25, we're really pleased to say there's no more contingent consideration to pay. And that really allows us to focus on reducing net debt for the business and being in a position where we can finance our organic growth opportunities. So as we go forward, we're better placed than ever to help our clients with the £138 billion challenge over the next 25 years to deliver on the net zero commitments that they've made. Thank you, everybody. I'm ready for questions.
Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do that just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Just while the company take a few moments to review the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions throughout today's presentation, and Paul, if I could hand over to you to share the Q&A, that'd be great, and then I'll pick up from you at the end.
Yeah, absolutely. Thank you, Alessandro. So I guess the first one for myself, how was your cash flow in relation to this time last year? So as we saw from a cash generated from operation perspective, particularly strong versus this same period last year, and driven by that profile of optimization project revenue. So we had the unwinding of the activity into the period end last year in this period, and a lighter period in terms of activity levels in H1 versus H2 last year, which drove that high 80% cash conversion metric, below operating cash comparable to last year, as I say, in terms of contingent consideration, interest costs clearly higher. I think the most important thing looking forward from a cash flow perspective is clearly that cash flow in 12 months' time will look notably different for the first half of next year, in that we won't have that circa £9 million of contingent consideration that we've seen in the first half of the last 3 financial years, which starts to give us the confidence and visibility, and in turn investors that visibility of the deleveraging of the group nearer to 1 times, as we've stated we intend to do so. I guess a question linked to that, again for myself, is when do we think that net debt will peak, and when is it likely to reach 1 times net debt to EBITDA? So I think we're currently in the peak period now, so the half year period on the back of those non-operating cash outflows in the first half of the year. But because of the profile of trade in the second half of the year being very much Q4 weighted, and then that working capital unwinding at the start of 2025 will remain at the peak levels through the remainder of this period. And then you'll start to see that deleveraging as more of the operating cash is able to drop through to reduce net debt. So I think by the end of 2025, per the guidance we've put out this morning, we expect it to be nearer to 1.5 times. And then halfway through 2026, we expect to be nearer to 1 times net debt to EBITDA. Another question, I'll pass this one to you, Mark. Unify appears to be a key enabler for Inspire's broader services. Can you share any plans to further develop this platform, and what role will software services play in scaling the business in the next few years?
Yeah, so we're really pleased with the performance of our software division and the proprietary software Unify, as referenced, which really is the flagship suite of modules which help businesses deliver assurance and ESG services to their customers, and for customers to be able to consume those services. So I guess kind of one of the key things for me that I find really pleasing in terms of the quality and the fact that hopefully we're getting this right in terms of the development roadmap is that more than 60 market participants now directly use this software, And when we've been winning those clients, we've been winning them as part of really intense procurement processes, where ultimately, we're being put up against every other solution in the marketplace, and we've been prevailing for some really quite significant clients, both from a direct point of view, where it might be large organizations, or for other assurance and ESG service providers. What's really important for us about that is that as we start to go through that process, clearly we're in a position where we can accelerate that software development, and with energy being a particularly technology laggard, really start to make a difference in the marketplace and ensure that we are market leading, not just now, but also into the future. So to your point about the development roadmap, ultimately, that's a continuous beast. We kind of have a roadmap which operates in a Kanban system, and those Kanbans are full. So effectively, it allows us to continue to build up different modules which will effectively continue to enhance the solutions provided to the client base. In particular, now we start to focus on more ESG-based solutions, as we see that marketplace moving from its nascent state into one where there's more of a consensus on what good looks like. And as with all our services, we focus on a data-driven bottom-up approach, which ultimately works very well for our core competence in processing unstructured data. I think the final part of that process is that where we've got to at the moment is building scale and presence on that software. It currently runs around about 500,000 meters for its customer base, which ultimately is well over 40% of the kind of industrial market. And with respect to that, what we also like is the kind of data asset that's building, which may give further opportunities in the future on an anonymized basis.
Thank you, Mark. Another one, I think, for you, Mark. Optimization services are currently your largest revenue segment. You mentioned a small number of significant contracts in this division expected to commence in Q4 2024, which could be pushed into 2025. Could you please advise how material these contracts being delayed would be from a top line and bottom line perspective?
Yes, I mean, as per the RNS this morning, ultimately, one of the things, as we've said, is that as we get better and at delivering solutions for clients, we get access to bigger projects. And ultimately, what we can't do with those projects is impact the way that the circumstances are affecting customers. So ultimately, when we gave the trading update, there was 3 outstanding. 1 is contracted. The other 2 are anticipated in Q4. Clearly, for us, this is kind of business as usual. Unfortunately, business as usual doesn't normally respect kind of like financial reporting periods, I guess, because ultimately, if we were thinking about this as a shift between Q1 and Q2, clearly it wouldn't be a topic of conversation. But from the perspective it does transcend the reporting period, ultimately those contracts, the gross margin impacted by the remaining 2 could be up to circa £5 million. And ultimately, in terms of that process, I guess a few things have to happen. First of all, you would have to have no site implementations during that period. And if those contracts did move, we are talking simply a moving and a deferral between Q4 and Q1. From our perspective, we continue to operate, helping clients work and develop those projects, noting that for every month the client doesn't actually implement a project, they're not making the saving in relation to cost and carbon. So we're kind of aligned in incentives, but equally those businesses have got other things that they have to deal with. And so at this moment in time, the key thing is to make sure that we're open and transparent about it. And in relation to developing and making sure that the integration between the Inspired optimization team and the Ignite business and the acceleration of that gives us the best opportunity to diversify client concentration into the future.
Thank you, Mark. Another one for you, Mark, unfortunately, in terms of talking. To what extent is AI an opportunity or a threat to Inspired services?
Yeah, so it's really interesting with AI, because I guess kind of ultimately the business processes large amounts of unstructured data, and so as AI gets better, you like to think that ultimately it provides a great opportunity, and we are open and cognizant to making sure we take advantage of that. However, as with everything else, your AI tends to be only as good as the algorithms you're training, and you can have lots and lots of data, but if you haven't got the right algorithms, then ultimately, you know, the impact can be not quite what people anticipate. So I think there's an element of AI being able to look for anomalies in relation to clients' performance and the performance of their sites. I think there's the opportunity to streamline some of the, if you like, interactions with clients, but obviously you're careful to make sure you don't lose your level of service. But I think kind of rather than people racing ahead thinking that ultimately AI can provide the kind of ultimate solution, what we normally find with both assurance service and ESG services is that the customer wants someone to present them with the answer and take responsibility for the accuracy of the answer and also what the implications of that answer are. So as we've said over many years, we've quite deliberately built the business as a technology-enabled service, where your dimensions of scale are probably 60% technology, 40% body heat. We do that because ultimately, whilst kind of we process a lot of data and deliver a lot of data-driven insights, clients want to be able to discuss that, and they want to be able to stress test it and sense check it with somebody who has got and is able to give an expert opinion. So I guess the headline is yes, we're definitely making sure that we have our R&D focused on AI. I think it's some years away before it has a material impact in the space, and our job is to make sure that we are matching our development to the market's propensity to consume AI delivered services, and we kind of spend our time focusing on that.
Thank you, Mark. Just to give you a chance to catch breath. So in terms of operational leverage in each division is a question. So I guess levels of current utilization, capacity of utilization for each division, and what level of operational leverage exists within each division.
Is that for me?
Could probably share, I guess from a software perspective, that's a straightforward one. It's a software business. In terms of cost base, that's undoubtedly an area in which it contains operational leverage. ESG, as I say, in terms of the evolution and stage of journey for ESG, that's about right sizing cost investment to maximizing opportunity from a top line perspective. So that's clearly very much in its infancy, in its growth phase. So that's where we're at with that. Assurance. So I guess, do you want to take assurance, Dave?
Yeah, so I think assurance, the main focus of assurance is delivering that absolute first-rate, first-class service and giving absolutely no reason for it not to be a good opportunity for introducing other services. So that does mean that there are costs, as we've seen previously, but also now pleasing to see that the margins are stabilizing where we expected them to do so. So that operational leverage and that investment we've made is starting to now pay dividends in terms of the retention rates and the attracting of new business into the group.
I guess optimization, Mark, to finish off in terms of capacity we've got there for growth.
Yeah, so I mean, I guess ultimately, one of the things we've done quite consciously over the last few years, noting that the markets, if you like, propensity to consume optimization services in relation to delivering on that net zero commitments was unknown. We've quite consciously let different parts of the organisation operate in a different way for delivering and sourcing, procuring those optimization services. I think as we've now gone through the period and been able to accelerate the integration of the Ignite and Inspired optimization teams, what we really have been pleased to do is to land on a single operating model, which is really about, you get many companies out there trying to sell, if you like, productized solutions to a customer. You need some LED, you need a BMS, you need some solar. Whereas in actual fact, the only valid question from our customer's point of view is, what do I do to reduce energy consumption and carbon emissions? And the next question is, what have I achieved in doing that? How well have I done? So from that perspective, as we start to answer that question, by combining the circa 120 people in the Inspired division with the 100 people in the Ignite team into that single operating model, what we find is we have the ability to significantly increase our capacity in relation to that delivery. So I'm really comfortable with the amount of operational leverage we have in the optimization division, and the ability to really kick on in terms of the number of clients we can simultaneously help manage the delivery of their own net zero commitments.
Thank you, Dave and Mark. I believe, Alessandra, that is the end of questions.
Perfect. Thank you very much for answering all those questions. Just before redirecting investors to provide you with their feedback, which I know is particularly important to you all, Mark, could I just ask you for a few closing comments?
Yeah, so I think kind of ultimately, if we think about where we've come from as a TPI business, a procurement business back in 2019, and our transformation into a full suite sustainability services provider, that strategy has really been put in place to give us a competitive advantage for the market we see today. So our thesis is predicated on the fact that ultimately the most valuable service provider to the customers is not just the ones who can solve the complexity of managing unstructured data and managing the risk of utility costs or making ESG disclosures and delivering their strategies, but really it is the company that can also help the clients with the specific interventions that they need to do to remove carbon emissions and wasted energy consumption from their portfolios to allow them to actually deliver their net zero targets. So our business now, as we go into 2025, where companies are actually having to make good on those promises, is really well positioned to help those customers meet the challenge of the estimated £138 billion cost over the next 25 years for them to deliver on their net zero commitments. And we're really excited about the opportunity to do that.
Mark, Paul, David, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Inspired PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.